Hey everyone, in this video we're going over 5 stocks I'm buying before the new year. Now before getting into those stocks, if you could smash the like button, it really helps the YouTube algorithm, and if you haven't subscribed to the channel, definitely subscribe. Now let's get into the first stock. So the first of 5 is Best Buy, ticker BBY. This stock is trading for around $100 a share, just under it at the close of today. It's almost a $25 billion company, 24 and a half, and it currently has a price to earnings ratio of under 10 at 9.65. They have a dividend yield of 2.81%. Their 52-week high was $141.97, so they are down significantly from there, and their 52-week low was just around $94.54 as well. So basically, we're close to the 52-week bottom on this stock. I think this is a great buy going into the new year. Now, the question I first asked when I saw the dividend is, can they afford the dividend? And it's a resounding yes. They're paying 2.83% dividend, and this is only 25.65% payout ratio. So of the cash flow they're generating, to pay this dividend, they're only paying a quarter of that cash. They still have 75% of the cash, which allows them to not only invest in themselves, but also do things like buybacks, which this company does as well. I then checked into their earnings growth. In 2018, they did $1 billion in earnings. In 2019, it was $1.46 billion. 2020, $1.54 billion. And in 2021, this past year, over $1.8 billion in earnings. So this company is clearly earning a lot of money on their fiscal years. They are growing their earnings year over year. So I like to see that. They are also growing their overall revenue year over year. So the company is in good shape. Of course, we don't know where things will go in the future, but if we're looking at their past, we can see they have continued to execute very well. I then looked at their price to earnings over time to get an idea of where their PE usually is for this company. Well, right now it's under 10, it's at 9 point something. And if you see on this video I put here, I was just going past the last 5 years or so. I mean, this PE at some points was above 20. And, it hasn't been in the last 5 years this low at a 9.6. So we are really trading at an all-time low as far as a price to earnings for Best Buy. So, when you take the fact that you're trading at an all-time low with earnings getting as high as they've ever been and continuous growth in them over the last few years, it's just starting to look like a great deal. Buybacks coming, dividend being paid. I like Best Buy going into the new year. So I'm adding it. That's the first stock I am adding of 5. Next, we have AT&T and Discovery as number 2 and number 3. Both of these stocks, I'm pairing them as 2 and 3 because at the end of the day, they are related. When you take AT&T shares, you will be receiving Warner Bros. Shares since they are splitting off Warner Media to merge with Discovery stock. So some people might decide to buy AT&T, some might decide to buy Discovery. I'm personally buying both, and I'll get into a little of the reasons of why you may want one or the other when we get into the details. So first, we're starting with AT&T. AT&T stock is trading at the close at $24.82. This is very close to their 52-week low, which was not long ago at $22.02, and their 52-week high, to put that in perspective, was $33.88. Now, this stock has a market cap of $163 billion right now. If you include their debt, though, their enterprise value is $343 billion. Trailing PE I would not pay attention to because there's a few things factored there. If we look at their forward PE, though, where they really are trading at, it's 7 times earnings on a forward PE base. Extremely, extremely cheap valuation right now, fundamentally, assuming that they can pay their debts and you're not too worried about the debt they have. Now, AT&T has a massive dividend. It's been over 8%. That dividend will be cut in half after the Warner Media times Discovery deal happens with Warner Bros. Discovery. The dividend for AT&T should be around 4%. The management has said that it's going to be around 40 to 43% of cash flows, and they believe their cash flows will be around $20 billion after the merger is complete and they no longer have Warner Media. Now, that's a healthy and a high dividend in a stock that will be more focused on what they do best, which is their utility of internet and cell phone service, 5G, etc. So AT&T is cheap fundamentally, but it has optionality. At a forward P of just 7 times, AT&T is very cheap, assuming they can manage their debt, which I believe they can. And the great thing is, with the spinoff of Warner Media merging with Discovery, AT&T shareholders as a whole will be getting 71% of the new Warner Bros. Discovery company. This is a great optionality to shareholders of AT&T to get a piece of a company that will have a much higher multiple, most likely, due to media companies just trading at a higher multiple than utility companies. Now we get into the other side, the Discovery side. So Discovery, ticker DISCA, $24.33 right now a share at the close. Their 52-week high was astonishingly at $78.14, and their 52-week low, close to where they are right now, was $21.66. Now, this media company is trading at a very cheap valuation compared to the potential it has in the streaming business currently with Discovery Plus, and obviously huge potential once they have merged with Warner Media in the streaming industry. They're currently trading for an $11.5 billion market cap pre-merger. Their trailing PE is 12.5, and their forward PE at these prices right now is 7.29, so extremely cheap valuations. So if you own Discovery stock, DISCA, all of your shares will be converted into the new Warner Bros. Discovery company once the merger completes. And this new company will have some debt, but it's going to have a great library of content, and it's going to be able to compete very well in the streaming wars. Now, that does assume, though, that the management does go full throttle ahead on the streaming wars, puts their best content ahead on their streaming platform, and really takes advantage and executes very well. Now, if you're wondering the difference between should you own AT&T or should you own Discovery, you should buy AT&T if you want mostly exposure to the utility company of AT&T, you want steady cash flow and a nice dividend, and you'll also get a little bit of the shares from Warner Bros. New stock while keeping your AT&T stock. You should buy Discovery if you want only exposure to the new media company Warner Bros. Discovery. You prefer to have currently less cash flow but higher growth potential. You'll own no AT&T stock, so you're not going to get any dividend most likely because I don't assume that they'll pay one. But each share you have in Discovery will give you more of the new company. You're not going to get as much exposure to the new company because there's so many more shares for AT&T shareholders. There's much more shares outstanding. So even though AT&T is going to own 71% of this new company, you as an individual shareholder, share by share, there's so many shares of AT&T out there that you're going to get less of a stake than one share of Discovery will get of that new company. But you get to keep your AT&T shares. So all in all, if you want mostly exposure to AT&T, the company itself, less exposure to the new streaming company, go with AT&T shares. You want mostly exposure to the new company, no exposure to AT&T itself, you go with Discovery stock. Personally, I like exposure to both. That is why I'm adding both. Now let's go to stock number 4, and that is Meta Platforms, ticker FB, Facebook. This company is trading for $346.22 at the close of trading. It has a 52-week range between $244 to $384, so it is somewhere in the middle there. Now this has a market cap of just under $1 trillion at $917 billion. Its enterprise value, though, is lower because they actually have a high cash balance. So you're really getting it for $871 billion when you take into account the cash they have. Its trailing P is at 23.59 times, and the forward P at only 22.5 times. So Meta Platforms, in my opinion, is the cheapest of big tech. I actually made a video specifically on how Meta is the cheapest option when it comes to fundamentals, growth, value in all of the big tech world for all the stocks like Google, Amazon, Apple, Microsoft. I highly recommend you check that video out on my channel. I do a deep dive into why Meta is trading such at a better price. You're getting better growth and you're getting a better valuation. So I still like Meta, even though it has come up a little bit since that video. It has already risen a little higher, but it is still trading at a better valuation than the rest of big tech and has amazing growth ahead. Some recent news for Meta Platforms and why it actually jumped today was because we saw that the Oculus app was #1 on the Apple App Store, not just for like entertainment, for all apps. Now what that means is that Oculus and Meta had a massive holiday season. The Quest 2, which is a virtual reality headset sold by Oculus, owned by Meta, sold like crazy during the holiday season as gifts for people. And after they open that up, they have to download the Oculus app. So by seeing the Oculus app at number one on the top charts, we know a ton of people got Oculuses as gifts. And Facebook also owns number 5 and number 6, Instagram and the Facebook app during the holiday season. They were running as number 5 and number 6 of all apps being downloaded. Now, if you want to get a deeper dive of what the actual metrics for Facebook and whatnot, and why I think Meta is such a great company to own the stock at these prices, check out that video where I compare it to the rest of big tech. I highly recommend it. Now we're going to get into the 5th and final stock in this video, and that is, if you don't know it already from my other videos, it's the Walt Disney Company, ticker DIS for Disney. Now, this is actually my largest holding going into 2022. The stock is trading at $155.20 a share right now, slightly up today. Its 52-week high was $203 a share, and it has bounced up from its 52-week low, which it recently hit at $142.04 a share. Now, I mostly own Disney stock because of my long-term streaming thesis, and my very last video uploaded to my channel was actually on the streaming thesis. I definitely think you should check that out if you're interested in Disney stock for the long run. But after a year when this stock is down around 15% or so year to date and over 20% from its highs, I think we can get a nice bounce back in 2022 regardless of the long-term thesis that I have for 2025 to 2030. So I am adding shares for the long run based on my long-term thesis and streaming, but I'm also buying options for the short run. So let's start with the long-term thesis. In short, this is a basic version of one of my long-term theses. I have a few projections, but by 2030, I believe Disney is going to reach 500 million plus subs between Hulu, Disney Plus, ESPN Plus, Star, all of their direct-to-consumer products, paying at least $15 or higher a month by 2030. That's $90 billion in revenue or higher a year from direct to consumer alone, not including the rest of their businesses. That's a very high margin business when it's at scale. I believe that alone is going to lead to $1 trillion market cap by 2030. In the short term, part of my short-term thesis is this is the busiest time of the year right now at the parks. There's new ways right now to monetize the parks during the holiday season and going forward that have not really took into account in past earnings reports, such as Genie Plus, which is basically if you want to get through these lines quicker, you pay for Genie Plus. Besides paying for your ticket to get in, it's $15 to $20 a day per person that's there. And then for the most popular apps, they charge you up to $20 per person for those specific rides throughout the day. So you are going to be spending a lot more money than you used to at the Disney parks, and the Disney parks are packed right now. So I believe in this holiday quarter, Disney is going to smash expectations when it comes to their parks, when it comes to their revenue at their parks, and the profit on that revenue at the parks. Bob Chapek let us know in the last earnings when people are going to Disney parks due to these changes, they are spending more than ever before. And I think this is going to be the first quarter where we really see that in the earnings. Now that, along with the fact that I think we're going to see a big jump in subscribers across their direct-to-consumer business, Disney Plus, Hulu, and ESPN Plus, last quarter, we had a pretty bad quarter when it came to increased subscriber growth at Disney Plus. And one of the reasons it suffered was because of India. Yearly subscriptions were finishing around that end of quarter, and I believe a lot of them had now renewed for the IPL season that happened. So basically, all these subscribers in India, they don't pay month to month. They pay for an annual subscription, but it's not set to auto-renew. And kind of at the end, it was when the quarter ended. So a ton of people didn't have it, they don't have it on auto renew. They lost all those subscribers. They had to say what their subscriber was, but they re-got them back because a lot of those people in India are subscribed specifically for the IPL, the Indian Premier League, which is hosted on Disney Plus Hotstar, the service that they have there, which is Disney Plus subscribers. You then pair those people resubscribing along with what I think is going to be a big boost on Hulu Live TV from the YouTube TV problems we talked about earlier in this channel, which is basically Disney-owned networks that went offline on YouTube TV, which caused a bunch of their subscribers to unsubscribe from YouTube TV, and when they're looking for something else to go to, Hulu TV was a prime option for them to go to get especially Disney-owned networks like ESPN. And then you pair that with a big content push this quarter with movies like Encanto hitting Disney Plus for the holiday season, and the Book of Boba Fett, the new Star Wars show, which should be out right when I release this video, same day, December 29th. So needless to say, I am bullish on this quarter, so I bought options for the short term. Now, going over my options, you'll see I am being slightly risky with them. Options are always risky. They are short term. They do encounter the next earnings report, which I do believe to be the biggest catalyst besides this Santa rally going into the end of the year. So the next earnings report should be around February 10th or so. I bought 200 calls for February 18th, 2022, so right after that earnings call. Strike price was $135. I paid $21.56 a share. So the break even on these calls I'm buying is $156.56 a share. The stock price closed today at $155.20 a share. So I'm $1.36 a share away from break even, and then anything above that is profit to me. And this did cost me close to $500,000 at $429,500 current value for it. I do believe the fair price for this stock today is around $180 to $200 a share. Now, that is with it having a lot of room to grow even beyond that point, assuming my streaming thesis is correct for the long run. I am basing that fair price based on my streaming thesis. So with a strong holiday quarter, I do believe we can get back to the $180 range we saw not too long ago. It was at that price not that long ago, just before the last earnings kind of made the stock crash a little bit. I think a great earnings, a great holiday season could get it back to that 180 level. And at $180 a share, these calls would be worth at least $45 a share, which would be more than a 2x on my investment. So my $430 would be worth at least $860,000 if we got back to $180 a share. And to be clear, buying short-term calls is extremely risky because the stock will move up or down. The options will move up or down at a much greater pace than the stock will. And it is possible to lose the entire value. If the stock drops below $135 a share, I will lose this entire $430,000. And it's because of time. With stock, you can sit and wait as long as you want. If you're not on margin, you have indefinitely. You can wait till 2030, no problem, as long as you don't need the money. But with options, you have to be right by the date you put. So by February 18th, 2022, I have to be right. If the stock is not at least where it is, I will lose money if it goes down. I will lose it a lot more than the stock, and I have the potential to lose all of it with the stock not going to zero. Now, if you made it to the end of the video, please smash the like button. If you haven't, subscribe to the channel. Thank you so much for watching. And I'm curious, of the 5 stocks I'm adding, do you like any of them? If so, which are your favorites? Comment below. Best Buy, AT&T, Discovery, Facebook, and Disney. 5 stocks I am adding going into this new year. Until next time.